So I think the clients are focused first and foremost on employee welfare, like all responsible companies, and that goes for corporates or sponsors. I think also there are challenges as regards the operational issues, the supply chains, satisfying customers, because they obviously want to satisfy their customers and make the best of a very difficult environment. I think as we get past the immediate short-term adjustments, there's also a focus on balance sheet, because in a situation like this, it's important to conserve capital, and you want to make sure that you have sufficient liquidity, and you also want to do your best to ensure that you don't encounter some type of solvency problem. So M&A, in that respect, becomes slightly less of a priority because people obviously need to address those key areas.
We generally see periods of significant uncertainty being a negative impact on M&A volumes. When companies are unable to project their own financial results, let alone have a grasp of what's going to happen across the industry, it's very difficult to make a decision on a strategic transaction. And so we've seen a decline right now. We have seen some larger deals announced, but those are transactions that I would say have been discussed for some time, and they found opportune moments to announce them now. But in general, I think companies first need to understand their own business. Then they need to understand the businesses of the counterparty, and they need to be able to diligence that and make sure that they're comfortable with it. And those are all elements right now that are either taking longer if they're able to happen, and in some cases it's very difficult to even put a pin on it, because we don't know how long this impact is going to last in terms of the coronavirus. I will say though, if we look back at the last period where we had some significant downturn in the 08-09 credit crisis, for example, I think a lot of people got caught at that point with much lower cash balances than they have today.
Right.
And so I think from that perspective, companies are in a much better condition. And so we're likely to see less insolvencies or bankruptcies than we saw back then, which I also, from an M&A perspective, I think portends to a quicker rebound in terms of volume.
Yeah. We always knew that there would be a period of uncertainty around the U.S. election, just because of it will be a hotly contested election, and there will be true policy differences between the parties in areas like taxation, antitrust, overall regulatory environment. It's possible that something like this eclipses that, the fact that there's an election, the fact that there is this differentiation of possible outcome, means that it sort of will reinforce conservatism about deal making.
I think we definitely see demand, and it just depends on where that gets pushed out to. I think it's a matter of, it's not that it's going to go away. I think it's getting pushed to the right. And so as soon as there's some settling in the market, there's a lot of very strong conditions sitting on the sideline, whether it's cash that's available to do transactions, or assets that people have been looking to divest or sell that have to come to market. And I think the M&A market's probably going to lead versus having the equity markets be the alternative.
When you go into this type of triage, actually the interests of activists are very much aligned with the interests of boards and managers, which is keep the stock up as much as possible.
Yeah.
We have seen ongoing activist activity with very high-profile names, even amid the market break. Companies like Twitter, companies like eBay. That activist activity is going to continue, and in terms of stock picking, activists probably feel like they have some interesting opportunities, just given the indiscriminate dislocation of the market. But the advice vis-a-vis activists remains the same. Listen to what they have to say. They often have good ideas. Give them a hearing, and at the same time pursue the path that's best from a fiduciary perspective for the company.
There's still a lot of pent-up demand in the private equity industry, both in terms of dry powder to spend, which is at record levels from an all-time perspective, and in terms of portfolio companies that they're holding that they want to get liquidity on. I think there's a little bit of difficulty in pricing transactions in this market, but at the same time, they are finding opportunities. So if you look at the DXC sale of their health business to Veritas, that's a really nice transaction at $5 billion in size. So you're going to see some opportunities like that. The other thing is right now, one of the potential exit alternatives of taking a company public is certainly closed.
Closed, and that's a really good point.
And that makes it extremely difficult in terms of considering alternatives.
I'd say one more thing about our own institution. RBC really is in markets like this over many decades have been very supportive of our corporate and sponsor clients, and we stand ready to help people, and we're busier than ever fielding phone calls about these things because now is the time when when relationships really matter.